Over the last few days, the odds of a recession have officially doubled.
Luxury handbags, electric Hummers, Pokémon cards, and meme coins. What do they all have in common? For a fleeting moment, they were the golden tickets to financial freedom, or so we were told. Now, as markets wobble and recession whispers grow louder, a new wave of speculative behavior is taking shape. And it looks very different from the frenzy we saw just a couple years ago. Some people are still making bets, but this time, it's not about Lambos. It's about survival. So are these high-risk, high-hype assets making a comeback? Or are they the last gasp of a broken strategy? Either way, the answers may surprise you. This is Money Mastering Secrets, helping you keep more of what you earn and earn more from what you keep. The boom and bust of luxury speculation. From 2020 through 2022, luxury goods like Rolex watches, G-Class Mercedes, and even first-edition Pokémon cards skyrocketed in value. With stimulus checks hitting bank accounts and meme stocks and cryptocurrencies generating quick paper wealth, many retail investors dove into these high-end items not just for style, but as supposed investments. Scarcity, whether organic or manufactured, was marketed as a feature, not a flaw. Authorized dealers kept supply intentionally tight, building months or years-long waitlists. Meanwhile, gray markets flourished as people flipped these items for instant profits, reinforcing the illusion that luxury consumption could double as a wealth-building strategy. But the speculative frenzy didn't last. As the market cooled and interest rates climbed, reality hit hard. Items that once doubled in value overnight now often struggled to fetch retail price. One standout example was buyers taking out 8-year loans on electric Hummers, vehicles they plan to rent on Turo, only to end up $150,000 underwater as prices collapsed. The draw of quick returns led many to overextend, mistaking hype for sound financial planning. In today's shifting economic climate, marked by renewed recession fears and volatile stock markets, this bubble in luxury speculation serves as a cautionary tale. Not every flashy purchase is an investment, especially when it's built on shaky economic footing. But the obsession with shiny toys was just the beginning. What came next redefined what people thought counted as a smart investment. The term alternative investment, used to apply to assets like commercial real estate, private equity, or commodities, generally reserved for sophisticated investors with deep capital and long-term strategies. But over the past few years, that definition has expanded wildly to include everything from cryptocurrency and NFTs to limited edition sneakers and Logan Paul-endorsed Pokémon cards. These assets were sold with the same language used for traditional investments: high potential returns, scarcity, and diversification benefits. In reality, many of them were driven more by social media hype than fundamentals. With flashy influencers and YouTubers touting six-figure paydays from collectibles and meme coins, retail investors were lured in under the illusion of getting rich quick on assets they barely understood. However, the market correction exposed just how fragile these so-called investments really were. Prices for many alternative assets plummeted once speculative demand cooled, leaving investors holding the bag. It wasn't just a financial loss, it was a psychological wake-up call for those who thought exclusivity equaled stability. Today's heightened economic uncertainty, underscored by recent market sell-offs and renewed recession fears after President Trump's comments, makes the speculative nature of these investments even riskier. When confidence is low and volatility is high, assets built on perception rather than performance tend to collapse the fastest. As investors now question what truly holds value, it's a stark reminder that just because something is rare doesn't mean it's worth the risk. Economic volatility and shifting consumer sentiment. In recent weeks, financial markets have been on edge. A sharp sell-off saw the Dow drop 2%, the Nasdaq fall 4%, and the S&P 500 decline by 2.7%. A clear signal that investor sentiment is turning cautious. This wave of volatility was amplified by former President Trump's refusal to rule out a near-term recession, feeding uncertainty already brewing from tariff threats and global instability. While traditional recession indicators like high unemployment or back-to-back quarters of negative GDP haven't fully materialized, consumer sentiment has taken a hit. Slowing retail sales, wage growth stagnation, and rising personal debt levels point to a public that is feeling financially strained, even if the official data doesn't yet confirm a downturn. This sentiment shift matters because consumer confidence drives about two-thirds of the US economy. When people feel insecure about their finances, they spend less. And when they spend less, markets react. Even Elon Musk has added fuel to the fire with erratic public behavior, such as calling a sitting US senator a traitor during a moment of economic fragility. This kind of noise, paired with uncertainty around investment plans, job security, and the broader political landscape, further undermines confidence. For everyday investors, it's a crucial reminder that in volatile periods, emotional headlines and influencer chaos can be just as damaging to market stability as actual economic indicators. As fear ripples through the markets, one surprising corner of the investment world is struggling to recover. And it's not for the reasons you might think. Why luxury investments aren't bouncing back yet. Even as crypto prices surge and stock markets flirt with record highs, the luxury resale market is lagging behind, significantly. During the 2020 to 2022 boom, rising asset values created a windfall of cash for everyday speculators, many of whom funneled that newfound wealth into luxury goods. Now, with fewer retail investors striking gold on meme coins or NFTs, demand for status symbol items like Rolex watches or Hermes handbags has cooled. Prices on secondary markets have dipped, and what once seemed like a guaranteed flip for profit now looks more like a depreciating liability. What's changed isn't just the price tags, it's who holds the money. Today's gains are going to institutional investors and the ultra-wealthy, who already have access to luxury goods and don't feel the need to flaunt new riches. Beyond the economics, there's a cultural shift underway. Flashy displays of wealth, once the norm across social media and influencer culture, are now giving way to subtler, more cautious financial behavior. Rising interest rates, economic anxiety, and a softening labor market have made even high earners think twice before buying items that scream extravagance. And in places like China, previously the world's biggest growth engine for luxury brands, slumping real estate markets and government crackdowns on visible wealth have sharply reduced demand. Combine that with a domestic mood in the US that leans more skeptical of billionaires and their antics, looking at you, Elon Musk. And it's no surprise luxury investments are no longer seen as a sure bet. This isn't just a market correction, it's a reflection of changing priorities in a more uncertain world. Alternative investments like artwork, luxury watches, and rare collectibles may seem exciting, but they come with serious drawbacks, high fees, poor liquidity, and minimal regulation. Unlike stocks or ETFs, selling these assets often requires auction houses like Sotheby's, which can charge 20% or more in fees. The lack of transparency makes it hard for everyday investors to know if they're getting a fair deal, while insiders often hold the upper hand. These purchases are often driven by emotion, not sound strategy. A flashy watch or designer bag might feel like a status symbol, but that doesn't make it an investment. Many people convince themselves they're building wealth when in reality they're overspending on depreciating assets. With consumer confidence dropping and recession fears growing, fueled by volatile markets and political uncertainty, now is a crucial time to rethink how we define a smart investment. And just when you think the risks couldn't get any higher, the motivation behind these risky bets takes an even darker turn. What's fueling speculation today? The speculative rush that once thrived on hope has now shifted to desperation. Today, many retail investors aren't chasing riches, they're just trying to stay afloat. A Wall Street Journal survey found that low FICO score investors are primarily investing to pay off debt, not build wealth. With inflation biting and credit card interest rates soaring, risky assets like meme coins and NFTs have become lottery tickets for those under pressure. Sadly, most end up digging deeper holes instead of escaping them. This shift is unfolding amid growing economic inequality and global uncertainty. China's real estate crash and crackdown on lavish spending have hurt luxury demand, while in the US, rising costs and stagnant wages add to the strain. Meanwhile, political chaos, from Elon Musk's outbursts to Trump's recession hints, further shakes confidence. Despite market rallies, average investors aren't winning. They're just hoping to break even. It's a sobering reality that marks a pivotal shift in how retail investors approach risk. Thanks for watching. Like, comment, and subscribe for more smart money tips. Got a question or story? Drop it below. We might feature it next. Click the next video shown on your screen to keep learning with money mastering secrets.